Welcome to IRM Financial, the only place where we forge a stronger portfolio by cutting through market weakness. Today, we're putting Freshpet, ticker FRPT, through a full-blown financial stress test. Now, this company has been a Wall Street darling for years, a real high flyer, but the story is changing and it's changing fast. So we're going to tear down their financials, piece by piece, to forge a final verdict. Is this a solid steal opportunity or a trap waiting to spring? Let's get to work. Look, let's be clear. Freshpet isn't some flash in the pan. They clawed their way to a billion-dollar business by convincing pet owners to treat their dogs like family with refrigerated, premium food. It's a brilliant model. But every growth story, no matter how great, eventually hits an inflection point. And Freshpet is smack dab in the middle of that turning point right now. The days of easy, explosive growth are over. Now the real heavy lifting begins. And that's the whole game right now, isn't it? The billion-dollar question. For years, the narrative was just pure, uncut hype. Explosive growth, quarter after quarter. The stock was priced for the moon. But now, you can hear the music slowing down. We're seeing the first real, undeniable signs of deceleration. So our job today is to put on the hard hats. We're going to act like structural engineers and inspect this company's foundation, right down to the rebar. Is it built on solid rock? I'm talking real sustainable profits, strong cash flow, a defensible moat, or are we about to find some serious cracks in the concrete? Is all that past hype enough to carry it into the future? That's what we're here to forge a verdict on. Exactly. And the first, most glaring stress point we have to put under the microscope is that top line, the growth engine. For a stock that has been priced for perfection, any sign of a sputtering engine is a massive red flag. And this isn't some minor tune-up we're talking about. The data shows this company's all-out sprint is slowing to a jog, and the market is starting to ask if it can even hold that pace. This slowdown, right here, is the single biggest change to the Freshpet story. So what's the company's official line? Well, here it is, straight from the CEO's mouth. He's basically telling the market, hey, the good times can't roll on forever. When a CEO says they're not immune to swings in consumer sentiment, that's carefully crafted corporate speak. It means our expensive premium food is taking a hit because people's wallets are getting tighter. This quote is absolutely crucial because it's management themselves on the record resetting expectations downward. They're lowering the bar. And you can see the impact right here. It is stark. The company's growth rate was literally chopped in half, from a blistering 27% down to 13%, in a single year. That is a violent deceleration. But hold on a second. Management blames consumer sentiment. Okay, fine. But does that feel a little too convenient? A little too simple? When growth falls off a cliff that fast, you have to start asking harder questions. Is there something deeper going on? Are competitors finally catching up? Are they running out of new fridge space in stores? It just feels like an easy excuse for a really dramatic drop. That's a fair challenge. So let's do it. Let's drill down and inspect the main load-bearing beams of this entire structure, the sales numbers. The top-line revenue is what holds everything else up. It supports profitability, it supports cash flow, and ultimately, it supports the stock price. If this beam is weak, the whole building is at risk. So let's put the raw numbers up on the screen and see what story they're really telling us. All right, first, let's give credit where it's due. Freshpet officially crossed the billion-dollar sales threshold. Hitting over $1.1 billion is a massive milestone. It's definitive proof that this is a real, substantial business. They've built something big with a loyal customer base. This, right here, is a pillar of genuine strength. It's a solid piece of steel in their foundation. And even with that slowdown we talked about, the full-year growth still came in at 13%. Look, in a tough consumer environment, growing a business of this size by double digits is nothing to sneeze at. Management would point to this and say, see, we're not collapsing, we're just maturing. We're shifting into a more durable, sustainable growth phase. Yeah, but the market doesn't care about the annual average. It cares about the trend. And the trend is ugly. That 13% number for the full year completely buries the lead. Look at the most recent quarter, Q4. Growth cratered to just 8.6%. It went from nearly 30 down to 13, and now it's in the single digits. So the deceleration isn't just happening, it's getting worse. It's accelerating downward. To me, that's not a pillar of strength. That's a major crack forming in the foundation, and it calls everything else into question. Okay, that point is undeniable. The decelerating growth is a fact, and it's not a pretty one. But this is exactly where the story takes a sharp turn. It seems like management sees the writing on the wall. They know the hypergrowth party is winding down. So what are they doing? They're pivoting. They're shifting focus from just breakneck expansion to actually reinforcing the core structure. They're all about profitability and efficiency now. It's a classic move. If you can't get bigger as fast, you better get stronger. They're trying to prove they can build a self-sustaining fortress, not just a high-growth startup that burns cash. And on the surface, here's the evidence they'd present. Look at this table. Adjusted gross margin ticked up slightly. Okay, good. Adjusted EBITDA, which is a key measure of profitability that Wall Street watches, shows really solid growth, up to almost $196 million. But the real eye popper, the headline grabber, is that net income number. It nearly tripled, skyrocketing from less than $47 million to a massive $139 million. If you just glance at this, it looks like a huge success. The pivot is working wonders. Whoa, whoa, whoa. Stop right there. This slide asks the exact question that should be flashing in neon lights for every single investor. How on earth does your net income triple, a nearly 200% gain, in the same exact year that your revenue growth gets chopped in half? The math just feels greasy. It doesn't add up. A 13% sales bump and a tiny little nudge in margins should absolutely not lead to a tripling of your bottom line profit. This number looks way too good to be true. And whenever you see that in a financial statement, you need to go find the footnote. There's something hiding under the hood here. And there it is. There's the answer. Take a look at this chart. Almost half, nearly 50 cents on every dollar of the company's entire net income came from a one-time tax benefit. In accounting speak, they released a valuation allowance. All you need to know is that it's an accounting maneuver, it's not cash, it's not from selling more dog food. It's a non-cash, one-time boost that makes the profits look artificially huge. So no, operational profit didn't triple. They just got a big assist from their accountants. You can't build a durable investment case on that. That's not reinforcing the structure, it's just slapping on a new coat of paint to hide the cracks. You're not wrong. The quality of that net income is definitely questionable. But let's move on to a number that's a lot harder to fake: cash flow. This is the lifeblood of any company, and for years, Freshpet was a cash furnace, just burning through millions to fuel its growth. But in 2025, they finally did it. They flipped the switch. This transition from burning cash to generating cash is arguably the single most important and impressive achievement in their entire report. This is how you build a real financial fortress, with cold, hard cash. And here's the number that proves it: positive free cash flow of $12.4 million. Now that might not sound like a huge number, but the direction is what matters. This is a massive inflection point. It means that after all expenses, after paying for all the new factories and equipment, the company is finally funding itself. It doesn't need to borrow money or sell stock to keep the lights on. That is the hallmark of a truly sustainable, durable business. This chart really puts it into perspective. Look at the swing. In 2024, they burned through almost $33 million. A year later, they generated over $12 million. That is a $45 million positive turnaround in just 12 months. That shows a huge improvement in operational discipline. This is the real heavy lifting we've been talking about, and it strengthens the company's foundation more than any accounting gimmick ever could. A fortress, huh? Let's stress test that idea. Look, generating positive cash flow is a good start. I will absolutely grant you that. But a real fortress needs more than just one good quarter of cash flow. Look at the balance sheet. At the end of the year, Freshpet had $278 million in cash. That's a decent war chest. The problem? They were also carrying almost $400 million in total debt, so they are still deep underwater, with over $100 million more in liabilities than cash. That introduces serious risk. If the economy takes another dip, or their growth slows even more, that debt becomes an anchor around their neck. A true fortress isn't leveraged like this. That is a valid concern, and the debt is definitely a variable we have to watch closely. So we've tested the past. Let's turn our attention to the future. Let's look at the company's official blueprint, their 2026 forward guidance. This is management's promise. This is what they are telling Wall Street they can deliver. It tells us everything about their priorities and what they think is realistic. This is where we find out if that newly reinforced structure is built to handle future pressure, or if they're already planning for a smaller, slower reality. All right, let's break down the blueprint. For 2026, they're projecting 7 to 10% sales growth. They expect EBITDA to keep climbing, and, crucially, they say they will remain free cash flow positive even while they continue to spend heavily on new capacity. To me, this looks like solid, responsible, grown-up guidance. They're not chasing hype anymore. They're prioritizing sustainable, profitable growth. But is it responsible, or is it a white flag? Guidance of 7 to 10% growth is a formal admission from the company that the high growth story is dead. This is no longer a growth stock, it's a single-digit grower.
For a stock that still carries a premium valuation, that's a toxic combination. This isn't a blueprint for a skyscraper, it's a blueprint for a bungalow.
And that brings us to it, the final verdict. We've run the numbers, we've done the stress test, we've inspected the load-bearing beams, we've celebrated the structural supports, and we've definitely uncovered some potentially dangerous cracks in the foundation. So now it's time to weigh all the evidence and forge a conclusion. Is Freshpet, at this critical turning point, a well-built opportunity? Or is it a trap, a former superstar whose best days are in the rearview mirror? Let's summarize the bull case. The argument here is that the foundation is solid and it's actually getting stronger. This is a billion-dollar company that is now self-funding. That positive free cash flow is a massive de-risking event. They're showing clear operational discipline with improving margins, and let's not forget, they are the dominant player in their niche, with a strong brand and plenty of room to grow within the massive $38 billion dog food market. The heavy lifting to build a durable, profitable company is bearing fruit. And now for the bear case, the cracks in that very same foundation. The number one glaring issue is that severe deceleration in growth. Going from almost 30% to high single digits changes the entire investment thesis. That shiny net income number was propped up by a one-time accounting trick, which masks weaker operational results. They're still carrying more debt than cash, which creates financial risk in a downturn. And their own guidance confirms that this slower growth isn't a temporary blip. It's the new normal. The danger here is you're paying a growth stock price for a value stock's growth rate. That's a classic trap. So what we're left with is a company at a truly fascinating crossroads. It's a paradox. The bull case says Freshpet is successfully maturing, transforming from a cash-burning startup into a durable, cash-generating industry leader. The foundation is getting stronger. But the bear case says the very growth story that built that foundation is now fundamentally broken. And what's left is a slower, more vulnerable business than the market seems to realize. It is a textbook battle between improving operational strength and a deteriorating growth narrative. And that leaves us with the final, crucial question that you, the investor, have to answer. Has Freshpet already done the hard work, the heavy lifting required to forge a lasting enterprise? Or, with its growth engine sputtering and a significant debt load still on the books, is the most difficult work just beginning? That is the core of the debate for anyone looking at this stock today. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.